Here's an uncomfortable truth that most people never confront. The majority of individual investors underperform the market not by small margins, but dramatically. Studies consistently show that the average investor earns returns far below what they would have achieved simply buying an index fund and doing nothing. This isn't a matter of bad luck or lack of intelligence. It's something more fundamental. Most investors are set up to fail before they make their first investment. The failure isn't in their stock selection, though that's often poor. It isn't in their market timing, though that's usually disastrous. The failure is in their mental framework, their expectations, their understanding of what investing actually is, and their psychological preparation for the emotional challenges they'll face. They enter the game with beliefs and behaviors that make success nearly impossible, and they never recognize this until years of mediocre or negative returns force them to confront reality. Think about what this means. Millions of people spend hours researching stocks, reading financial news, analyzing charts, and managing portfolios, only to achieve results worse than if they'd done nothing. This isn't just sad, it's revealing. It tells us that effort without proper thinking is not just useless, but actively harmful. It tells us that activity is often the enemy of results. It tells us that most of what passes for investing is actually speculation, gambling, or simply flailing around without a coherent framework. Charlie Munger often observed that the best way to get what you want in life is to deserve it. In investing, most people never position themselves to deserve success because they fundamentally misunderstand what success requires. They think it requires finding great stocks or timing market moves or being clever. In reality, it requires avoiding stupidity, controlling emotions, thinking long-term, and having the discipline to stick with sound principles through inevitable periods of doubt and difficulty. The tragedy is that investing success is not particularly complicated. The principles are straightforward. The math is simple. The strategy is clear. But the psychology is brutal, and most people are never prepared for the psychological warfare that investing wages against your natural instincts and emotional responses. This video examines why most investors fail before they succeed, what specifically dooms them, and how you can avoid their fate. We're not going to discuss which stocks to buy or when to enter the market. We're going to discuss something more fundamental: how to think about investing in a way that gives you a genuine chance at long-term success rather than guaranteeing failure. If you're looking for exciting predictions or hot tips, this isn't the right video. But if you want to understand why investing is so difficult psychologically and how to structure your approach to overcome these challenges, then let's examine the predictable ways that investors sabotage themselves. The first reason most investors fail is that they begin with completely unrealistic expectations about returns, timelines, and what success actually looks like. These unrealistic expectations create a cascade of problems that doom them from the start. Consider what most people expect from investing. They see headlines about stocks that doubled or tripled. They hear stories about investors who got rich quickly. They read about hedge fund managers making billions. They absorb a constant stream of information suggesting that large, fast returns are normal and achievable if you're smart enough or work hard enough. This creates expectations that are divorced from reality. The stock market has historically returned about 10% annually over very long periods. This is before inflation, which has averaged around 3%. So real returns are closer to 7%. This is excellent and will compound into substantial wealth over decades. But it's not exciting. It won't make you rich quickly. It requires patience that most people don't have. But people don't want to hear about 7% real returns over 30 years. They want to hear about doubling their money in a year. They want to believe that with the right strategy or the right information, they can dramatically outperform. And there's an entire industry of financial media, newsletter writers, and investment products designed to feed this fantasy. The problem is that these unrealistic expectations create unrealistic behavior. If you expect 20% annual returns and you're getting 10%, you feel like you're failing even though you're succeeding. This dissatisfaction leads to changes in strategy, increased trading, higher risk-taking, or chasing whatever has recently performed well. All of these behaviors reduce returns further, creating a self-fulfilling prophecy of underperformance. Let me be specific about what realistic expectations look like. If you're investing in a diversified portfolio of stocks through low-cost index funds, you should expect roughly market returns, which historically have been around 10% nominal, 7% real. Some years will be much better. Some years will be much worse. Some years will be negative. Over decades, the average will probably be in this range. But there are no guarantees. If you're trying to beat the market through individual stock selection, you should expect to fail because most professional investors fail to beat the market after costs. You might succeed, but the odds are against you, and the effort required is substantial. This doesn't mean you shouldn't try if you're genuinely committed to the work, but you should go in with realistic expectations about difficulty and probability of success. The rational investor starts by accepting these realities. They don't expect to get rich quickly. They don't expect to consistently beat the market by large margins. They don't expect investing to be easy or exciting. They expect it to be boring, difficult psychologically, and rewarding only over very long time horizons. This mindset shift is essential because it aligns expectations with reality, which prevents the disappointment and impatience that lead to destructive behaviors. Think about what happens when you have realistic expectations. You're not disappointed by normal market returns. You're not tempted to chase hot stocks because you understand that consistent compounding at reasonable rates is the path to wealth. You're not constantly changing strategies because you understand that no strategy works all the time, and success requires patience. You're psychologically prepared for the long journey ahead rather than expecting immediate results. Most investors never make this mental adjustment. They enter the market with lottery ticket thinking, expecting outsized returns quickly. When reality doesn't match expectations, they blame the market, the economy, their broker, or bad luck. They never recognize that their expectations were the problem all along. The second reason most investors fail is that they confuse activity with progress and intelligence with results. They believe that success requires constant attention, frequent trading, and sophisticated strategies. In reality, these things usually reduce returns rather than improving them. The investment industry has powerful incentives to encourage activity. Brokers make money on trades. Financial media needs constant content. Investment products need to justify their fees. Everyone in the ecosystem benefits from convincing you that investing requires active management, constant monitoring, and frequent adjustments. But the data tells a different story. Study after study shows that frequent trading reduces returns. The more you trade, the worse you typically do. This isn't because trading is inherently bad. It's because each trade has costs, both explicit and implicit. Commissions, bid-ask spreads, taxes, and most importantly, the behavioral errors that come from trading based on emotions, noise, or incomplete information. Consider the typical pattern. An investor buys a stock, it goes up, they feel smart, it goes down, they feel anxious, they check the price frequently, they read news about the company, they see other stocks performing better, they sell, often at a loss, and buy something else that seems more promising. The new stock underperforms. They repeat the cycle. Each transaction costs money and usually represents buying high and selling low, the opposite of what creates wealth. The paradox is that doing less would produce better results. If that same investor had simply bought a diversified portfolio and ignored it for years, they would almost certainly have more wealth. But doing nothing feels irresponsible. It feels lazy. It doesn't satisfy the need to feel in control or to feel smart. So people trade, they adjust, they tinker, and they destroy value in the process. Charlie Munger and Warren Buffett have talked extensively about their ideal holding period being forever. They're not joking. Their approach is to find businesses they understand, buy them at reasonable prices, and hold them indefinitely, unless something fundamental changes. They make very few decisions, but they make them carefully. They reject the idea that constant activity is required or beneficial. This is difficult psychologically because humans are wired for action. When markets are volatile, doing nothing feels dangerous. When opportunities seem to present themselves, passing on them feels like leaving money on the table. When everyone else is active, being passive feels foolish. But these feelings are precisely the problem. They lead to actions that feel productive but are actually destructive. The rational approach is to structure your investing so that activity is unnecessary and difficult. Use index funds that don't require stock selection. Automate your contributions so you don't have to decide when to invest. Set up your accounts so that checking them frequently is inconvenient. Create rules for yourself about when you're allowed to make changes, and make those rules strict. This isn't about being lazy. It's about recognizing that in investing, unlike most areas of life, less is often more. The investor who makes 10 carefully considered decisions over a decade will typically outperform the investor who makes 100 decisions, because each decision is an opportunity for error, and errors are far more common than brilliant insights. Think about what this means for how you spend your time. If you're spending hours each week researching stocks, reading financial news, and managing your portfolio, you're probably hurting your returns rather than helping them. That time would be better spent earning more money, developing valuable skills, or simply enjoying your life. The effort to return ratio in active investing is terrible for most people. The third reason most investors fail is that they don't understand their own psychology and have no systems in place to protect themselves from their predictable emotional responses to market movements. They rely on discipline and willpower, which inevitably fail under stress. Let's talk specifically about what happens psychologically during market cycles. When markets are rising and your portfolio is growing, you feel smart. You feel in control. You check your balance frequently because it's pleasurable. You might even increase your risk exposure because you're confident. You start to believe that your recent success is due to your skill rather than market conditions. Then markets turn. Your portfolio declines. Suddenly, checking your balance is painful. The pleasure turns to anxiety. You start questioning your strategy. You wonder if you should sell to prevent further losses. You read alarming headlines about how much worse things might get. Other people are talking about their losses. The anxiety intensifies. At some point, the pain becomes unbearable. You sell often near the bottom, telling yourself you'll get back in when things stabilize. But when markets do recover, they often move quickly, and you miss the rebound, or you're too scared to reinvest, or you wait for a pullback that doesn't come. You've locked in losses and missed the recovery. This pattern is so common that it's essentially universal. The emotional arc of greed during bull markets and fear during bear markets has repeated throughout history. Every investor faces these emotions. The difference between successful investors and unsuccessful ones is not that successful investors don't feel these emotions. It's that they have systems in place that prevent them from acting on these emotions. Think about what it means to have systems rather than relying on discipline. Discipline means trying to do the right thing through willpower when your emotions are screaming at you to do something else. This works for some people some of the time, but it fails for most people most of the time, especially during extreme market conditions when emotions are most intense. Systems are different. Systems remove the need for discipline by making the right choice automatic and the wrong choice difficult or impossible. Let me give you concrete examples. A system for avoiding panic selling. Don't give yourself easy access to your investment accounts. Use retirement accounts that have penalties for early withdrawal. Set up your brokerage account without mobile access. Make selling require multiple steps and deliberate effort rather than being a button click away in a moment of panic. A system for consistent investing. Automate your contributions so money moves from your paycheck to your investment account without any decision required. You can't forget to invest. You can't decide to skip a month because markets look scary. The system executes regardless of how you feel. A system for avoiding overtrading. Create rules for when you're allowed to make changes and make those rules strict. Perhaps you only review your portfolio quarterly. Perhaps you require a written analysis of at least 5 pages before making any trade. Perhaps you have a mandatory waiting period between deciding to trade and executing. These friction points give your rational mind time to catch up with your emotional impulses. The key insight is that you cannot trust yourself to behave rationally when emotions are intense. This isn't a moral failing. It's human nature. The rational response is to accept this reality and design systems that protect you from yourself. Most investors never do this. They rely on their ability to stay calm and rational during market turmoil. They tell themselves they won't panic. They promise themselves they'll stick to the plan. And then, when their portfolio drops 30% and financial media is predicting catastrophe, and their friends are talking about losses and their amygdala is firing warning signals, all those good intentions evaporate. They act emotionally and they regret it later. The fourth reason most investors fail is that they focus on the wrong time horizons and fail to understand that short-term results are mostly noise while long-term results are mostly signal. This misunderstanding leads to constant strategy changes that prevent any single approach from working. The stock market is essentially random over short periods. Daily movements are noise. Weekly movements are mostly noise. Even annual movements have substantial random components, but over longer periods, fundamentals matter more and randomness matters less. Over decades, owning productive assets has reliably created wealth despite countless short-term scares and setbacks. Most investors focus on exactly the wrong time frame. They obsess over daily or weekly movements. They evaluate their performance annually or even quarterly. They change strategies based on 1 or 2 years of results. All of this is focusing on noise rather than signal, and it leads to terrible decisions. Consider what happens when you evaluate a sound investment strategy over too short a time frame. Value investing, for example, has worked well over very long periods, but it can underperform for years at a stretch. If you evaluate value investing after 3 years of underperformance, you might conclude it doesn't work and abandon it, potentially right before it outperforms again. You've given up on a sound approach because you measured it over an inappropriate time frame. Or consider international diversification. There have been long periods where international stocks underperformed US stocks. If you evaluate this strategy after such a period, you might conclude that international diversification is pointless and concentrate everything in US stocks. But the rationale for diversification is about reducing risk and ensuring you're not entirely dependent on one market, and that rationale remains valid even during periods of underperformance. The rational approach is to choose a strategy based on sound principles and long-term evidence, then give it enough time to work before evaluating it. For most investment strategies, this means decades, not years. You need to see the strategy through complete market cycles, including both bull and bear markets, before you can reasonably assess whether it's working. This requires extraordinary patience because humans are wired to respond to recent events. If something has performed well recently, we assume it will continue. If something has performed poorly recently, we assume it will continue. This recency bias is powerful and wrong. Mean reversion is one of the most reliable patterns in markets, but it requires patience to benefit from it. Think about what this means practically. You need to structure your investment approach so that you're not constantly evaluating it. You need to avoid the temptation to compare your results to other investors or to different strategies over short periods. You need to accept that any sound strategy will have periods of underperformance, and these periods are not reasons to abandon the strategy. Most investors never develop this patience. They're constantly looking for something better. They see other approaches working and feel like they're missing out. They abandon strategies before they've had time to work. They end up strategy hopping, always moving to whatever has recently performed well, which guarantees buying high and selling low at the strategy level. The fifth reason most investors fail is that they underestimate costs and taxes, which can consume a staggering portion of returns over time. Small differences in costs compound into enormous differences in wealth, but most people pay almost no attention to this. Let's be specific about the math. Suppose you have two investment options, both target the same returns, but one charges 1% in fees annually, and the other charges 0.1%. Over 30 years, assuming 10% gross returns, the low-cost option will leave you with substantially more wealth, roughly 25% more. That 1% annual difference compounds into a massive difference in outcomes. Now consider that many actively managed mutual funds charge 1 to 2% or more. Add in trading costs, taxes on turnover, and advisor fees, and you can easily be giving up 3 or 4% annually. This is devastating. If the market returns 10% and you're giving up 3% to costs, you're only getting 7%. Your real wealth accumulation is less than half what it would be with minimal costs. Most investors don't think about this carefully. They see fees listed as percentages and assume they are small. 1% doesn't sound like much, but 1% of your total portfolio taken every year, compounding over decades, is enormous. It's the difference between financial security and struggling. The rational approach is to obsess over costs in a way that most people don't. Use low-cost index funds wherever possible. Avoid actively managed funds unless you have strong evidence that they'll outperform by enough to justify their costs, which is rare. Minimize trading to minimize transaction costs and taxes. Use tax-advantaged accounts to defer or avoid taxes entirely. Every dollar you save in costs is a dollar that can compound over your investment lifetime. Think about taxes specifically. Every time you sell an investment for a gain in a taxable account, you owe capital gains taxes. If you're trading frequently, you're generating taxes constantly, and those taxes come out of your returns. If you hold investments for years, you defer taxes, allowing more of your capital to compound. If you hold until death, your heirs get a step up in basis, and the gains are never taxed. The difference between active trading and buy and hold in a taxable account can easily be 1 to 2% annually just in taxes. Most investors are shockingly careless about this. They trade in taxable accounts without considering the tax implications. They use high-cost products without comparing alternatives. They pay advisors percentage-based fees without asking whether the advisor is actually adding value beyond what they could achieve themselves with low-cost index funds. The sixth reason most investors fail is that they lack genuine diversification, not understanding what diversification actually means or why it matters. They think they're diversified when they're not, and they're vulnerable to risks they don't recognize. Diversification is often misunderstood. It doesn't mean owning lots of stocks. You can own 50 stocks and be poorly diversified if they're all in one sector or one country or one type of company. Diversification means owning assets that respond differently to different economic conditions, so that no single event can destroy your wealth. Consider someone who owns stock in 10 different technology companies. They think they're diversified because they own multiple stocks. But if the technology sector declines, all their holdings will likely fall together. They have company-specific diversification, but not sector diversification. They're still taking concentrated risk. Or consider someone who owns only US stocks. They might own thousands of companies through index funds and feel well diversified, but they're entirely exposed to the US economy and market. If US stocks enter a prolonged period of underperformance, as has happened in other countries, their entire portfolio suffers. Real diversification means spreading risk across multiple dimensions, different asset classes, different sectors, different geographies, different company sizes, different styles. It means owning some bonds alongside stocks to cushion volatility. It means owning international assets alongside domestic. It means not having your human capital and investment capital both tied to the same industry or company. The rational approach to diversification is to think about what could go wrong and ensure that no single scenario wipes you out. What if the US enters a prolonged recession? What if inflation surges? What if deflation takes hold? What if your specific industry declines? A well-diversified portfolio won't thrive in all these scenarios, but it should survive all of them. Most investors fail to diversify properly because they chase returns. Whatever has performed well recently, they want more of it. If US growth stocks have soared, they concentrate there. If real estate has boomed, they load up on REITs. They're always fighting the last war, positioning for yesterday's winners to continue winning, when mean reversion suggests they should be doing the opposite. The seventh reason most investors fail is that they don't have a genuine investment philosophy or framework, so they're blown around by every wind of opinion, every market movement, and every competing idea. Without a coherent philosophy, you have no basis for decisions and no way to evaluate whether you're on track. An investment philosophy is not a strategy. It's deeper than that. It's a set of beliefs about how markets work, what creates value, what risks matter, and what your edge is, if you have one. It's a framework for making decisions that's grounded in evidence and logic rather than emotion or fashion. For example, a value investing philosophy might include beliefs like markets are generally efficient but sometimes misprice assets, especially when emotion runs high. Buying assets below intrinsic value provides a margin of safety. Patience is rewarded as prices eventually reflect value, and my edge comes from longer time horizons and willingness to be contrarian. A passive indexing philosophy might include beliefs like markets are largely efficient and difficult to beat after costs. My time is better spent earning money and living my life than trying to pick stocks. Broad diversification and minimal costs are the keys to success, and I have no edge in stock selection, so I shouldn't try. Both of these philosophies are coherent. They lead to specific actions and decisions. They provide a basis for evaluating results. They help you stay consistent through market cycles. What they have in common is that they are thought through and they're consistent with evidence. Most investors have no philosophy. They don't have coherent beliefs about how markets work or what they're trying to achieve. They pick stocks based on tips or recent performance. They buy mutual funds because someone recommended them. They follow strategies they don't understand. When results are poor, they have no framework for evaluating whether the strategy is flawed or whether they just need more patience. Without a philosophy, you're vulnerable to every pitch, every hot trend, and every period of doubt. You'll chase performance. You'll change strategies constantly. You'll never develop expertise because you're not working within a consistent framework, and you'll almost certainly underperform. The eighth reason most investors fail, and perhaps the most fundamental, is that they never truly accept uncertainty and the limits of their knowledge. They want to feel in control. They want to believe they can predict the future, and they make decisions based on false confidence rather than honest assessment of probabilities. Investing is fundamentally about making decisions under uncertainty. You don't know what will happen to the economy, to interest rates, to specific companies, to markets. You can develop informed opinions. You can assess probabilities, but you cannot eliminate uncertainty, and pretending you can is dangerous. Most investors never make peace with this. They read a compelling analysis and treat it as fact rather than opinion. They see confident predictions and believe them. They make decisions as if they know what will happen, then feel betrayed when reality differs from their expectations. The rational approach is radical humility about what you know and don't know. You understand that your knowledge is limited. Your predictions will often be wrong. Your analysis could be flawed. The future is fundamentally uncertain. Given all this, how should you invest? The answer is to make decisions that are robust to being wrong. Diversify so that no single error destroys you. Avoid leverage so that volatility doesn't force you to sell. Maintain adequate cash reserves so that you're never forced to liquidate investments at bad times. Choose strategies that work even if your specific predictions are wrong. This acceptance of uncertainty is psychologically difficult because humans crave certainty. We want to feel in control. We want to believe we understand what's happening and what will happen. In most domains, feeling confident helps performance. But in investing, overconfidence is one of the most reliable paths to failure. Think about what genuine acceptance of uncertainty looks like. You don't obsess over predictions. You don't pretend to know what markets will do next year. You don't make leverage bets on specific outcomes. Instead, you position yourself to benefit from long-term economic growth while protecting against the inevitable short-term volatility and uncertainty. You make peace with not knowing, and you structure your approach accordingly. If you've made it this far, you're clearly serious about understanding why investing is so difficult and how to position yourself for success rather than failure. This channel exists to explore these psychological and philosophical aspects of investing that matter far more than tactical details about which stocks to buy. If this approach resonates with you, I'd appreciate if you liked this video and subscribed. There's no hype here, no promises of easy money, just honest examination of what actually matters for long-term investment success. Let me close with this thought. Most investors fail not because investing is impossibly difficult, but because they approach it incorrectly from the start. They have unrealistic expectations. They're too active. They lack systems to protect themselves from their emotions. They focus on the wrong time horizons. They ignore costs. They're poorly diversified. They lack a coherent philosophy. And they never accept the fundamental uncertainty of investing. Each of these problems is solvable. You can adjust your expectations to reality. You can commit to lower activity. You can build systems that remove emotion from decisions. You can extend your time horizon. You can minimize costs relentlessly. You can diversify properly. You can develop a coherent philosophy. And you can make peace with uncertainty. The difference between investors who fail and investors who succeed isn't intelligence or information access or luck, though luck certainly plays a role. The difference is in their mental framework, their expectations, their systems, and their ability to stay rational over long periods when emotions are intense. This is not easy. If it were easy, most investors wouldn't fail. But it is simple. The principles are straightforward. The challenge is entirely psychological and behavioral. Can you maintain realistic expectations when others are getting rich quickly? Can you be inactive when activity feels productive? Can you stick with a strategy through years of underperformance? Can you ignore the noise and focus on the signal? Can you accept uncertainty and invest anyway? If you can do these things, you have a genuine chance at investment success. Not guaranteed success, because nothing is guaranteed, but a real chance, better odds than most investors give themselves, and the possibility of compounding wealth over decades while most others are spinning their wheels or moving backwards. The investors who succeed over lifetimes aren't the ones who were brilliant or lucky, though some are both. They're the ones who avoided the predictable mistakes that doom most investors. They're the ones who understood their psychology and designed systems to protect themselves. They're the ones who accepted reality as it is, rather than as they wished it to be. They're the ones who gave compounding time to work because they didn't interrupt it chasing false promises of faster wealth. You can be one of these investors. The path is clear. The obstacles are predictable. The question is whether you'll actually walk the path, or whether you'll fall into the same traps that catch everyone else. Most investors fail before they ever succeed because they never set themselves up to succeed. They approach investing with the wrong mindset, wrong expectations, wrong behaviors, and wrong time frames. They rely on discipline when they need systems. They chase performance when they need patience. They act when they need to do nothing. Don't be most investors. Understand why they fail and do the opposite. Accept that success in investing is boring, slow, psychologically difficult, and available to anyone willing to think clearly and act rationally over very long periods. That's the path. It's not exciting, but it works. Thank you for watching.